I'm Taylor Riggs in for Emily Chang, and this is the best of Bloomberg Technology, where we bring you all of our top interviews from this week in tech. Coming up, chipmaker rally. Micron stock hits the highest price in 18 months after the company reports earnings. We'll break down the numbers as semiconductor optimism swells. Plus, holiday gifts on the brain, but how are they getting to grandma's house? We explore Amazon's delivery system as it ditches longtime logistics partners UPS and FedEx. And the year that was, we check out how big tech companies Apple and Facebook fared in 2019 and how each is set up for the new year. We begin with a look at tech in the markets, most notably semiconductors. Taking a look at the SOX index, we see that chip makers bottomed out nearly a year ago and have been on a rip-roaring rally since then. Chipmaker Micron adding to that sentiment as the company reported first quarter earnings Wednesday. Micron impressed Wall Street with a strong outlook of between $4.5 to $4.8 billion in revenue. Its shares have been on a tear in the latter part of this year. Shortly after the company reported, I got insight from Wedbush securities analyst Matt Bryson, who joined me on the phone after the analyst call.
They are seeing tightness in certain areas in DRAM. Also, they're calling a bottom for memory in general. They think this current quarter is going to be the bottom of the cycle. That fits with the tightness in certain areas of DRAM. That fits with the fact that they saw NAND pricing move up in the quarter just reported. It also it very much parallels the guidance they gave for flat gross margins, which again suggests that pricing is normalizing finally.
Does this have any implications for CapEx or an expansion of capacity?
So I think at this point they are remaining conservative in their CapEx outlook. They're keeping their CapEx guidance steady. I think that's the prudent thing to do, to wait for demand to come back. They did note that there is a point of uncertainty in terms of how much inventory China's accumulated. Just coming back from Asia, that's something I continue to hear from systems builders over there. So I think they're taking the prudent course right now and not yet investing in CapEx. If the recovery continues, I'd expect that memory in general will look to support their customers and expand capacity, but that's not happening yet.
Matt, I'm showing a chart to our terminal audience right now in my terminal, which is, as you described, the share price of Micron, and then it is the lower and lower DRAM and NAND memory chip prices. We've been calling for a bottom really for a lot of 2019. Are you confident that we've truly hit a bottom in those memory chip prices?
So I think on NAND, I am. Looking at pricing moving forward, I believe that contract negotiations around solid-state drive pricing have been concluded favorably for calendar Q1, so Micron's fiscal Q2. When you look forward in the NAND space, you've got a huge driver of demand in new gaming consoles, which are shifting from hard drives to SSDs. And then you also have an added boost in a better handset outlook, in part predicated upon 5G. On the DRAM side, it's slightly more difficult to call. Having said that, I'm starting to hear that server DRAM contract is moving up. So in my mind, that's the first sign that we've really bottomed on the DRAM side. Also, spot pricing over the last couple of weeks has started to rebound. The large cloud customers, who are an important point of demand for DRAM, have increased their buying. And so, while there's not quite as much visibility there, I think that we have seen a bottom.
That was Matt Bryson of Wedbush Securities. Tesla shares soared to a record high this week, hovering near Elon Musk's goal of $420 a share. You may recall that back in August of 2018, he tweeted that he sought to take Tesla private at $420 a share. The most recent stock surge, however, came from a report that Tesla is considering cutting the price of its China-built Model 3 sedans by 20% or more next year. More on that story. I talked to Bloomberg's Craig Trudell.
You do have a lot of electric vehicles and just cars in general that are priced, even some premium cars that are priced below where you see the Tesla Model 3. And, when the price came out for the made in China Model 3, I think it caught a lot of people a little bit by surprise because it's not that big a difference. And the whole sort of reason for building this plant locally is the idea that they can bring the price down by avoiding import duties and so forth. But I think what you're seeing Tesla make a bet here is that there's going to be just a sort of natural sort of goodwill of getting a plant opened, getting governments on board. There are a lot of government purchases of electric vehicles in China, and Tesla making a bet that the sort of initial buzz about having the Model 3 built in China will itself kind of carry them for the first 6 months next year, and then you bring the price down after that.
Craig, I want to show a chart that I'm showing here inside my terminal, which is just sort of the big headwind and the macro backdrop that is slowing car sales across the curve really in China for the last year or so. Is a 20% price cut enough to offset this drop in demand?
That's a really good question. I think if you're Elon Musk and you're looking at that chart, you're a lot more nervous about sort of the state of the China market than, really if you look at when those drops were really sort of kicking in. It's around the time that Tesla was, getting a deal, signing on the dotted line to get this plant built. It was built extremely quickly. It's unusual for this was a muddy field in January of this year, and we're talking about a plant that's already opened and cranking out cars, potentially delivering them to customers and within the next few days or weeks. This all happened extremely fast, and we have seen some softness in the China market, but the degree to which the market really deteriorated this year, I think, caught a lot of car companies off guard. And it is a cause for concern if you're Tesla, despite the fact that you have, real brand power and a lot of star power as a company that is sort of on the leading edge of electrification.
So, Craig, what's changed for Tesla that they can afford bringing the price down now instead of just from the get-go, given that some customers could just wait and hold out and not buy it and wait until prices drop, right?
I think that's a really interesting point, and it'll be interesting to see how long they can hold out before doing a price drop. When you think about what Tesla has been up to this point, it's been a company that's made all of their cars in high-cost California. It's not, it does not have, serious manufacturing, breadth across the world and in some lower cost markets. So labor costs are going to come down significantly. You're able to avoid levies and tariffs and get special treatment in terms of incentives and so forth. So definitely you could see that price come down further if the initial demand isn't quite what they're expecting here.
That was Bloomberg's Craig Trudell. After ditching UPS and FedEx, how Amazon is bulking up to meet this holiday shipping expectations. We'll find out next. And if you like Bloomberg News, check us out on the radio. You can listen on Bloomberg app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg. With less than a week left before Christmas, it is do or die time for the delivery machine Amazon has been assembling over the past few years. As it's ditching longtime logistics partners like UPS and FedEx, the e-commerce giant is beefing up its delivery system to prepare for the strain of holiday orders and expectations. I spoke to Bloomberg's Spencer Soper Wednesday from Seattle.
It's handling more of its deliveries than ever before. So it's estimated about half of all Amazon packages will be delivered by this system that Amazon's created. This is independent contractors who start their own businesses by leasing a bunch of vans and hiring people. It's also these flex drivers, which are kind of do like an Uber type app where they use their own vehicle and deliver packages for Amazon. It's the first year that Amazon is doing so much of its own last mile delivery so aggressively. And we've got, some hints of bad weather coming. That's always the big wild card. A system that can work great through decent weather can break down in bad weather. So a lot of it's going to be dependent on Mother Nature.
Well, and those are things that are outside its control, and there's also things that are inside its control, like that last mile. Have they mastered that last mile delivery?
Well, they're spending a lot of money on it, and they're doing a fairly decent job. They're, independent experts who monitor the shipping things are saying they're hitting, 90% plus, basically on par with FedEx and UPS. They're also doing things differently than UPS and FedEx, and a big part of it is having, multiple trucks or even these backup flex drivers hitting the same neighborhoods on the same day. So, when you think about seeing a postal truck, you'll usually see it maybe once a day, and then it's gone. You won't see it again until tomorrow. You might see multiple Amazon vans and vehicles crisscrossing your neighborhood on the same day. That's considered inefficient in logistics, but Amazon is saying, you know what, this is necessary to provide the capacity we need and to get everyone their packages in time for Christmas.
And Spencer, am I right or jumping too many hoops if I wonder if we should start looking at Amazon as a logistics company, no longer an e-commerce company?
Yeah, they've been a logistics company for years. It's always been more the back end part, the warehouses and storage and packing items, that sort of thing. So they've been in the logistics game for a very long time. We're just seeing them, increasingly branch out from that with the planes and now with the last mile of delivery, which is really the most visible. So, you may be used to see most commonly the Postal Service truck and the big brown UPS truck. Now you're likely seeing those blue Amazon Prime vans as frequently or more frequently than you're seeing anything else.
That was Bloomberg's Spencer Soper. Now, one of the biggest sources of funding for Silicon Valley startups, the SoftBank Vision Fund, was the focus of a Bloomberg Businessweek cover story. The report cited employees depicting a culture of recklessness within SoftBank. Bloomberg's Sarah McBride helped bring this story to light, and she joined me on Wednesday.
He's an incredibly interesting guy. He is a Korean immigrant to Japan. He grew up in this very kind of hardscrabble way, super smart, came here to the US, attended Berkeley, moved back to Japan, started SoftBank. One of the things that stood out about his background for me was in 2000, he invested $20 million in Alibaba, and that stake is now worth $130 billion. So he's a smart guy.
And what do we know about his management style and how it has sort of fueled this environment for these outside bets?
Well, he's a go big or go home guy. So he just wants his portfolio companies and his investment professionals to just keep thinking bigger, bigger, bigger. So sometimes that's great. Like when a young entrepreneur comes to him and he tells them, oh, you're going to be the next Jack Ma, your company is going to be even bigger than you think. Have you thought of this business idea or that business idea? But then sometimes he gets impatient. We have this detail in the story about how during a conference call, he was talking to one of his investment professionals about Full Truck Alliance, a Chinese company, and was basically saying, why are your outlooks for this company so small? This company can be big, and was sort of berating this guy on the phone for not thinking big enough in a way that made other people on the call feel embarrassed.
And when we talk about some of these outside bets, Sarah, frankly, we wouldn't be here. We wouldn't be focusing on the company so much if it weren't for WeWork and sort of the big debacle of WeWork. Do we know anything about if WeWork has structurally changed anything within inside that culture of SoftBank as you just described?
Well, after the WeWork derailed IPO, they really had to rethink things. And Masayoshi Son expressed a kind of, he said he regretted how everything had played out at WeWork and how it had created some changes in thinking inside the fund. They're still going to think big and press people to grow their companies as hard and fast as they can, but I don't think it's going to be growth at all costs anymore.
That was Bloomberg's Sarah McBride. And you can read more of this story and others in the December 23rd issue of Bloomberg Business Week. Coming up, big tech is on the quest for dominance in consumer banking. We'll discuss how it's all shaking up fintech with one of the latest unicorns in the space, Brex. Plus later, an app that helps you rake in the money during the holiday shopping season. This is Bloomberg. Apple Wallet, Uber Money, Google checking accounts. It seems like everywhere you look, big tech is getting into the financial services game. So what's that trend doing to fintech? We asked the CEO of recently minted unicorn called Brex. It has a partnership with MasterCard. Enrique Dubagras joined me Tuesday. I asked him about the financial product opportunities.
I believe that there's a clear distinction between distribution and actual innovation in financial services. I think a lot of the big tech companies, what they're doing is just creating new distribution channels for existing products. So for example, Amazon's credit card is issued by JP Morgan and American Express. And, I truly believe that if there's no technology development in the back end, it won't change much. I think a lot of the opportunity are for both fintech firms and non-fintech firms that actually rebuild the technology behind it and don't use the technologies built by the bank.
So as you talk about that and some of the partnerships, I noticed that you have a partnership with MasterCard. What are you hoping to bring them and what are they bringing you in terms of that technological innovation?
I think it's an exchange of knowledge. They, have been working with banks in a global market and, have accumulated a lot of knowledge and expertise over the years. And we bringing the side of technology and innovation from Silicon Valley, it's a very solid partnership because we can learn of them, they can learn of us. And also, we get to use their, big distribution network. So Brex card works in anywhere that MasterCard works.
And how are you hoping to differentiate yourself? You've talked a lot and, we talked a lot about Uber Money, for example. With your technology, what else are you hoping to use to try to make sure that you stand out in what is a very crowded field?
So the first thing we do is we focus on businesses instead of consumers. A lot of the focus has been on building, financial services for consumers. Brex is fully for businesses. Number two is we rebuild the entire system from scratch. So we don't use any kind of legacy software provided by the banks like most of these other companies. We basically rebuilt everything from scratch, and that allows us to create functionality that didn't exist before. So for example, not requiring any kind of personal guarantee on business cards or having extremely simple expense management on your card.
How are you expanding outside the traditional fintech world? I'm thinking into e-commerce or life sciences businesses. Are you increasingly taking on more clients from those new sectors?
So we basically are of the view that, you can't pull businesses together into one thing. Like a startup and an e-commerce company and a hotel and life sciences and restaurants, they're all completely different businesses. And in the future, a lot of the products will be catered to these verticals instead of being generic to SMBs, right? The same way in the consumer world, there are new fintechs focused on millennials and the affluent and the underbanked. We think in business it will start being focused on the verticals, so restaurants, startups, e-commerce, life sciences, etc.
I wonder, we've been showing your valuation, getting a newly $2.6 billion valuation over the summer. I ask a lot of the unicorns that come in here if it's helpful or hurtful, given the extra scrutiny that comes with now being valued at more than $1 billion.
I think, for us, as a financial services company, is definitely more on the helpful side. Brex is a fairly capital-intensive business because we're lending money. In order to lend money, we need money. So in order to establish credibility with our customers, with our banking partners and our stakeholders, the valuation definitely helps. But more than that, being able to raise a large amount of money is what is enabling us to actually go and disrupt this sector of financial services, which is full of very big and established banks. It's really hard to do that without the money.
That was Brex CEO Enrique Dubagras. Now, robots have replaced thousands of routine jobs on Wall Street, and now they're coming for the higher-ups. That's a contention of Marcos Lopez de Prado, a Cornell University professor and the former head of machine learning at AQR Capital. Lopez de Prado testified in Washington earlier this month about the impact of artificial intelligence on capital markets and jobs. He joined Bloomberg's Sherry On and me on Tuesday.
Today we have data sets that were not available 2-3 years ago, and the only way to model these data sets is utilizing these complex techniques.
So, for example, when you say data, how is this different from, say, 10 years ago to just a few years ago, and how fast has the change been?
Yeah, so a few years ago we didn't have data from satellite images, credit card transactions, engineering data that comes from exploration and production, or even data that comes from narratives, reading stories, extracting sentiment from news articles. So these data sets didn't exist before, and today they exist, and they are able to, we can extract information that is valuable for making investment decisions.
Marcus, I wonder if this is a zero-sum game. If the robots and the machine learning wins, then the high-paying finance jobs lose, or if there is a way to retrain some of these employees.
There is definitely a way to retrain these employees. The reality is that as a matter of productivity gains, not all of them will be able to retain their jobs, but in many cases we can retrain these individuals so that these algorithms augment their capabilities. They don't need their jobs to be completely automated, but these algorithms can assist to help them make better investment decisions.
And how vulnerable is the finance industry to, say, crowdsourcing to engineers in other fields? And what could it do, say, to the hedge fund industry, for example?
That's right. So Tournament is a particular case where we can crowdsource the forecasting of prices on all sorts of asset classes to the data science community. This is a job that so far has been done by a very narrow set of individuals within hedge funds, but now you can turn this information to the entire data set community. People working at NASA, at national labs, working at pharmaceutical companies, and they can use their expertise to forecast these returns and turn these decisions into investment products.
Marcus, I found it fascinating in your testimony when you were talking about Renaissance Capital, for example, which has been one of the early adopters of machine learning, average annual returns of 35%. How far off are we from this becoming a crowded trade where everyone uses this, that those outsized returns are no longer outsized?
It is still a very small percentage of the total AUM, the total assets under management. So when you think of the tens of trillions of dollars that are being invested today using discretionary decision-making processes or even quantitative decision processes that are not based on machine learning, this is still, there is a lot of room for deploying these algorithms, and this is not a crowded trade by any means.
And of course, we're seeing investments not only on skilled individuals, but also on students, right? You have to train these students to actually go and work with the data and the algorithms. What happens if you continue to see these US-China trade tensions and you educate them here, and then visa procedures become harder, all of these people leave the United States?
Yeah, so this is one of the concerns that I think many professors we have, especially at technical disciplines. 90% of our students are here on a visa. And most of these students will graduate, they will not be able to stay in the United States. And as a result, we are essentially training our competitors.
That was Marcos Lopez de Prado, professor at Cornell University. And coming up, making money while you shop. A Japanese e-commerce site wants to help you do just that. We'll hear from the company's president next. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Taylor Riggs. It's the final stretch of holiday shopping season, and e-commerce platform Rakuten is confident it can attract customers with the best deals and a cashback program. But how does the Japanese online retail company make money? In an exclusive interview, Rakuten President Kristen Gohl spoke to Bloomberg's Alex Steele Tuesday about their business model.
The holiday shopping season is really interesting this year, particularly because we have one less week between Black Friday and Christmas this year. So what we're seeing is unprecedented deals at a massive amount of retailers. I think you're definitely seeing marketplaces pop up in a big way. Their deals are aggressive, but also an interesting trend is in the direct-to-consumer world. We have a lot of retailers like Rothy's and Chewy and all of these smaller players that are increasingly taking a place in the retail stage this year.
So where are they shopping? Is it going to be e-commerce? Is it going to be retail stores? And what areas are seeing the biggest uptick?
In terms of where people are shopping right now, we obviously saw a lot of really aggressive e-commerce shopping, particularly centered around Cyber Monday this year. Cyber Monday was definitely the day, even more than Black Friday, that everyone came out to play. I think with the consolidated time between Black Friday, Cyber Monday, and Christmas this year, it's going to change the patterns of consumer spending a little bit. We saw a big pop around Cyber Monday. There was a little bit of a lull while people kind of got ready for the Christmas holiday season, and actually this week, it's getting really, really aggressive again. This is one of the last days for people to shop online before Christmas, when things get shipped to them before Christmas. So what we'll see this week is a gradual shift towards things like buy online, pick up in store, and more in-store shopping, or towards retailers like Amazon or Verishop that offer one-day shipping overnight. We do a few things that are attractive for consumers. The first is that we pay cash back on transactions at 3,500 plus stores, which in its own right is attractive. The second thing is that we have all of the stores that consumers want to shop at. We really, really have a broad spectrum of stores in the retail industry. Everyone's very well represented. The third thing is that we amalgamate all of the deals from all of the retailers. We allow people to stack cash back on top of retailers' deals that already exist. So if they have a coupon code or if they have a sale going on, people can stack cash back on top of that coupon code and sale, and then use a rewards credit card on top of that, and the deal stacking there gets really, really aggressive. So a lot of value-seeking customers and people looking for the best deal.
So Kristen, how do you then make money? Because the cash back is it's definitely a real thing. Somewhere you can make like one for one, right? So how do you then, what's the business model?
So we have about 13 million members. It's a very large audience of people. Companies pay us to send traffic to them. So they pay a commission on each of the transactions that our customers make, and then we share that commission with our customers. So it's a pretty easy, pretty simple business model where everyone wins. They get the traffic, and then our members win in terms of getting the cash back.
So if you have some retailers, though, that get better at their omni-channel e-commerce section like Walmart has and like Target has, does that sort of step over you? They don't need you as much anymore? What do you notice?
Not necessarily, because there is a subsegment of customers for whom this is a very attractive value proposition, and they shop this way regardless of who is or who isn't on our platform. They will shop with the people on our platform because they are very loyal to us. So even if people get better at omni-channel, number one, we're playing increasingly in the in-store cashback space. So we offer not only online, but also in-store cashback. But also there are groups and audiences that these retailers can't reach without us.
That was Rakuten President Kristen Gohl. Coming up, proposed tariffs push Apple to the forefront of the U.S.-China trade standoff in 2019. But it was CEO Tim Cook's relationship with President Trump which may have helped the company avoid a steep levy. We'll explore some of the big tech stories of 2019 next. And what were the most downloaded apps of the year? We'll have those lists coming up. This is Bloomberg.
In San Francisco, a lot of tech action today.
Our top stories this morning in D.C. and
the Dow and the S&P.
Shall we? So the euro on a 7-day winning streak.
Moves in the currency stock averages down 0.5%.
We begin in the oil patch. Saudi Arabia.
Brent crude pretty much unchanged.
Welcome to Bloomberg, the first word Asia.
The U.S. and Japan duke it out over exchange.
China's slumping onshore bond market is
All All this week, we profiled some of the biggest technology companies and how they weathered the challenges of 2019. Facebook ended 2019 much as it began, under political and regulatory pressures over content moderation, acquisitions, data privacy, and plans for cryptocurrency. The social network's newsfeed proved no longer the lone crown jewel it once was. Acquisitions of Instagram and WhatsApp became more interesting in terms of their performance and potential.
Everything's growing. Facebook, Instagram, Messenger, WhatsApp.
Instagram and WhatsApp have been the breakout successes for Facebook with ad revenue and record-breaking app downloads. But Facebook's plan to integrate their platforms have caught the eyes of the Federal Trade Commission, which may try to stop the plan to merge the technology platforms. And this isn't the FTC's first look at Facebook. This past summer, the social network was slapped with a record-breaking $5 billion fine as part of a settlement over consumers' privacy rights.
Facebook betrayed the trust of its users and deceived them about their ability to control their personal information.
Data privacy is now also the focus of the European Union's Commissioner of Competition, Margrethe Vestager. She's investigating how data may be used to unfairly stifle competition. And no place was more focused on Facebook than Washington, D.C., where CEO Mark Zuckerberg appeared many times. At Georgetown University, he defended his decision not to fact-check ads from politicians.
As a principle, in a democracy, I believe that people should decide what is credible, not tech companies.
And it was Zuckerberg's congressional appearances that likely generated the most interest, as Facebook's cryptocurrency plan, called Libra, was called into question by lawmakers.
Is it a currency? Are you a bank? What is this association?
It's a very complex project, and as you say, it's risky.
And so Facebook enters 2020 in a risky place. With Libra set to launch in the new year, the project is now under review of the U.S. Justice Department, the FTC, and nearly all the state attorneys general. And with that kind of pressure, we'll have to see if Facebook investors stay or shy away. As for Facebook's performance in 2019, I got perspective from Techonomy founder David Kirkpatrick and Pivotal research analyst Michael Levine.
Wall Street just doesn't care about anything except growth and earnings and revenue. And in a year when Facebook got a $5 billion record fine, gigantically greater than any other company's ever been fined by the FTC for a privacy matter, and their stock still performed beautifully well for the year, you really have to say, well, we're not going to get any help from Wall Street in reining in a company that really needs to be reined in ways that frankly are hard, but let's face it, somebody's got to do it.
And Michael, I want to come and take a look at a chart that I also made especially for you, and it is the forward PE ratio of Facebook. I'm charting this relative to the other big competitors out there. Facebook, frankly, still undervalued according to that metric. Is that in part why the share saw the big gain this year?
Well, in terms of the gain, I mean, you'd had really awful performance in 2018. You had a couple quarters in the back half of the year where they basically missed numbers, so had derated pretty profoundly. I'd say if I look at even the reaction to conceivably trying to block the integration, which could be obviously a precursor to trying to break up the company, I think you actually are seeing a reasonable amount of conservatism factored into the multiple. I mean, since we launched coverage on the company, one of the tenets of our initiation basically was we've never seen a more hostile regulatory environment. So, I mean, I think truth be told, a lot of people were initially surprised that the stock didn't react more negatively to the headline, but there's an element of it's sort of been playing through if you look through a lot of the other names in big tech and the moves they've had this year.
David, comment on some of those antitrust issues that Michael was alluding to. Is there a case to be made for breaking up this company?
I'm not an advocate of breakup, but there's no question that the regulatory pushback this company's facing all over the world is really not like anything any company's probably ever seen. I mean, there is movement, against Google and to a lesser extent Amazon in a lot of these places too. But Facebook is the company that regulators are looking at in the EU, parts of Asia, the United States, both parties here. And it is true, despite the fact they had a pretty good year on balance in their stock, that they're still below their high. And they've been hurt by all these controversies that never seem to leave them. So maybe Michael's right. That it is factored into the stock. It's such an incredibly profitable company, and they have such an incredibly good ad business, which is Michael's expertise, that you got to give them credit for that. And if you want to make money in the market, this is a company that's going to keep raising its revenues and profits.
And Michael, as an analyst who covers the company, do you like what the company is doing in terms of trying to integrate all those platforms together?
I mean, is it just greater cement their control and, ostensibly why the government's conceivably trying to go after them? Yeah, it likely does. I mean, they have definitely not had a lot of success to date monetizing Messenger and monetizing WhatsApp. And a big part of why they've been so successful monetizing Instagram is they've got this phenomenal targeting engine and they've got the strong ad base in place, and you just can do a better job monetizing any of these assets better than pretty much anybody besides Google. So,
Michael, you talk about that, but one thing that struck out to me is Instagram Stories was effectively copied from Snapchat. Do you get nervous when the big ad engine of Facebook is a product that was copied and not innovated from within?
I think if you look at what they've done quite a bit of emulation. I mean, I'm trying to remember that expression, but basically it's the ultimate form of flattery is emulating. I mean, there's some things that they've innovated on, and there's a lot of it's something that's classically happened in tech for years. So have I been consistently blown away with what they've come out in terms of as new platforms? No, I have not. But as David mentioned, they've built a very good, durable ad business that performs for advertisers. So that keeps the dollars coming in the door.
That was David Kirkpatrick, founder of Techonomy, and Michael Levine of Pivotal Research. Apple also dominated the news in 2019 as its products were put squarely in the spotlight with a White House tariff threat. It was all part of the U.S.-China trade story and demand overseas. It was the shocked Apple system that sent investors scrambling. In a January letter to shareholders, Tim Cook cut the company's forecast. Quote, "We did not foresee the magnitude of the economic deceleration, particularly in Greater China." And it's Apple's relationship to China that has been under the microscope all year, amidst a global smartphone slowdown and trade tensions. But Apple might have an edge over its competitors when it comes to President Trump and possible tariffs, despite a slip of the tongue earlier in the year.
You've really put a big investment in our country. We appreciate it very much, Tim Apple.
One that Apple CEO took in jest. It's a relationship that the president seems to take to heart.
Others go out and hire very expensive consultants, and Tim Cook calls Donald Trump directly.
And that may be paying off for Apple in the long term when it comes to staying in Washington's good graces, like in November when Trump toured Apple's Texas plant after the iPhone maker moved production of its Mac Pros from China.
We made a great trade deal with South Korea, but we have to treat Apple on a somewhat similar basis as we treat Samsung.
Now Apple just has to see if this relationship does indeed bear fruit. As for Apple's performance in 2019, I got perspective from Gene Munster of Loop Ventures and New Street Research's Pierre Ferragu.
Let me maybe, Taylor, take you back to the beginning of last year when iPhone sales came down very significantly, and that was kind of the result of a very strong iPhone X cycle in 2018. And in 2018, the strong iPhone X cycle hidden the fact that iPhone users are still around. They still love their phone, but the first-hand buyers is a population that is not growing much anymore. And because iPhones are getting more and more expensive, they stick to their phone longer and longer. So that created a very depleted level of demand for the iPhones in 2018, in 2019, and towards the end of 2019 today. What we had is actually a fairly successful product cycle. That's the reason why you hear so much conflicting feedback from the market and the value chain. On one hand, there are very obvious indications that the iPhone 11 was very well received. People loved it. And at the same time, you still see in the market an element of weakness. The fact that
Closing out a decade, 2019 has been a landmark year for mobile, with the rise of apps like TikTok and the launch of new video streaming services like Disney+. Here to discuss this year's big players in the world of mobile apps, Danielle Levitas, Executive Vice President of App Annie.
So I think the key thing we saw from a download perspective is that the big popular social and communications apps that really drive so much of our activity on mobile continue to dominate again in 2019. So if you look at the top 10, you'll see social apps were 7 of the top 10 in terms of downloads, with Facebook claiming 4 of the top 5.
One of those also in there that caught my eye was Tinder. How has Tinder's explosion changed the social media landscape?
So from a monetization standpoint, we're seeing that it's not just video apps or music apps that have done really well to monetize in entertainment outside of games on mobile, but we're seeing that dating apps are starting to make their mark. And Tinder claimed that #1 spot in monetization outside of games. And so I think it's an indication of the natural social experience of what dating can. It's a social component, right? This ability to quickly communicate. In the case of Bumble, you kind of have to check out you've been matched with within a certain time frame, like within a day before you lose those matches. So there's also behaviors to bring people back. And we're seeing more and more competition. Tinder has a huge lead, but we are seeing so many other apps in that space continuing to grow.
And what's interesting, and you've sort of hinted at this, is the ability to monetize. Some of the most successful apps that you've seen that were downloaded have those recurring revenue, that subscription model, which, as we talk about on this program, so important to investors. How are they able to be successful for a generation, frankly, that's known for not wanting to pay anything?
I think it's a matter of value, right? If you deliver a great value for a service that is not a one-time sort of fulfillment, it's built into the experience. It's sort of expected. And so I think when you look at entertainment, you're generally not just, you might be binge watching something, but you're coming back for the next show the week later. Or in the case of music, right? People are listening to music in many cases that are subscribers day in and day out. And then dating has that similar sort of like people are using these apps really regularly over a continuous period of time. So I think they've captured and delivered on a value and unmet need that people didn't have outside of it.
And a lot of the subscription-based apps that you were really highlighting here are within the gaming sector. That is really just taken off, the rise of this virtual sort of online gaming. Is that really what you see fueling growth as well into 2020?
So gaming's an interesting one. So overall in mobile, gaming drives about 75 cents of every dollar consumers spend. Now, if you look specifically in games, though, that's typically in-app purchases. So people are buying gems or levels. Subscription just started to take off with things like arcade this year, for example. And so subscription, I think, is something to keep an eye on in 2020. We just started to scratch the surface with games. It's the one area that games is sort of behind on versus other categories. And I think that it'll be a new opportunity for publishers to monetize games that maybe didn't lend themselves well to in-app purchases.
My producer used to be a sports broadcaster producer. So we talk about 9 innings in a game. Where are we in those 9 innings in terms of apps really being able to utilize engagement and monetization as you think about sort of a wide variety of where we are?
Engagement is everything. So if you start with the fact that we spend roughly 3 hours a day in apps, and of that, about half of it goes to social. So that leaves roughly 90 minutes for everything else. Now, some of that might be transactional. You're Venmoing somebody, you're potentially doing some other activities, ordering a ride, a coffee, et cetera. But then you have all this entertainment and so forth. And so engagement starts to become about either time spent, or maybe it's more important to have sessions. So an app like Snapchat tends to lead in terms of sessions per user, versus an app like Facebook that really is tremendously successful in social in terms of time per user. And so, but they offer a different social experience. And so it's important to understand which of those metrics are generally, correlated and associated with a happy consumer.
One app we haven't talked about yet, but we talk about a lot, is TikTok. Huge growth overseas. Do you expect to see TikTok as successful in the US? When does it actually take off here?
So from the standpoint of TikTok, it's phenomenal. The app has reached about 665 million monthly active users globally. We estimate in the US it's about 20 million. So it's starting, right? But keep in mind, TikTok does lean towards Gen Z. and younger consumers. And so I think with 20 million users in the US, we're already starting to see some material and impressive adoption. It's just, yes, people are also using Snapchat and Gen Z, especially in the US, Instagram and so forth. But I think we're already starting to see some compelling adoption of TikTok even here.
And that does it for this edition of the Best of Bloomberg Technology, where we'll bring you all the latest in tech throughout the week. Tune in each day, 5 p.m. New York, 2 p.m. in San Francisco. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.